Good evening, India. This is CA Bikash Bogi from Mumbai. I welcome you all in this public meeting on Union Budget explaining direct tax amendments. I hope all of you are in best of your health. So, 1st Feb 2026 was an important milestone in many senses since this budget was presented on Sunday. Stock market was also open on Sunday. And this was the ninth budget of Honorable Finance Minister Nirmala Sitharaman. And there were lots of expectation from taxpayer and general public across India. And this year, so many of the amendments, many favorable amendments for taxpayers, many unfavorable amendments for taxpayers. In my presentation, I try to cover majority of the crucial amendments with practical examples. I would like to take question answer after completion of my session. So if any of you is having any queries with respect to direct tax amendments, you can write down your queries in the chat box of YouTube. After completion of my session, I will cover, I will try to cover all the questions in detail subject to permission of time by the tax group team. So I'm starting my presentation. Honorable Finance Minister during her budget speech has explained that they have made many procedural changes and they made many corrections on the process and law so that the life of the taxpayers can be easy. So let's see which are those changes. So for the sake of clarity, I have divided my entire presentation into various parts so that one can correlate all the stuffs in detailed way. So yeah. So one of the important amendment favorable for the taxpayer proposed by Finance Minister is with respect to updated return. So what is updated return? So in case of an income tax return, it can be filed within 9 months from the end of the financial year. So if you want to file your income tax return after the period of 9 months, then you can file only through the updated return. And if you want to file through updated return, then you need to pay additional tax 10, 20, 30, 50% or 70% depending upon the period of delay. You can pay the additional tax and you can upload the updated return. This was the earlier provision. So initially the time period of 9 months was very less. So and many of the organizations has done the representation with the government that okay, this should be increased further to give some relaxation. So through this Finance Bill 2026, a amendment has been proposed by Finance Minister, wherein Honorable Finance Minister has stated that okay, now you can file revised return up to the period of 12 months. For the period of 9 months to 12 months, you need to pay some additional fees. Just pay the additional fees and upload the return. And in that case, you don't need to pay some additional tax as per the earlier provisions. Just pay the nominal additional fees and you can file your revised return up to 12 months from the end of the financial year. Earlier, in case of updated return, taxpayer were not allowed to correct the losses. So what is the proposed amendment with respect to this particular stuff? So now taxpayer can reduce the loss. Suppose taxpayer has filed a return and they have claimed a loss of 10 lakh rupees and subsequently they realize that so actual loss was 5 lakh, so there was a mistake. So now they can file the updated return reducing the loss. So this is a welcome move. So it increases voluntary compliances from the part of the taxpayers. Another important amendment in this particular stuff has proposed that in case of reopening of scrutiny matters, reopening of any scrutiny. So suppose in case of a taxpayer, a reopening notice has been issued. So earlier, what was happening that the after issuing of reopening notice, the proceeding was started, and it resulted into completion of assessment, reassessment proceeding, penalty, and all other stuff. And these proceedings were carrying over for 3 to 5 years, and so is to avoid all these litigations. An amendment has been proposed in updated return which says that in case of reopening, so if you have received a reopening notice from income tax officer, and as per that notice, once you receive the notice, then you find, okay, oh, I missed this income. So then what you can do now, as per this proposed amendment, you are allowed to file an updated return, and you can pay additional tax. In case of reassessment proceeding, you need to pay tax, an additional tax of 10% over and above the prescribed tax. So this is a welcome move in favor of taxpayer to avoid the litigation, and this amendment will be effective from 1st April 2026, and that is for tax year. Since the Income Tax Act Income Tax Act 1961 got changed with Income Tax Act 2025, and in the Income Tax Act 2025 there is no concept of assessment year or previous year. This is tax year. So this amendment will apply to tax year 2026 2027. So I've already covered this in my so there is extended time frame for filing the revised return. So now we can file the revised return without paying additional tax. So we can just pay some nominal fees and we can file our return. So this is a welcome move, and this is also applicable from tax year 2026-27. This is not applicable for financial year 25-26, for which the date is already passed, that is 31st December 2025. Yes, so again, this is a welcome move proposed by finance minister. So many of the taxpayer, we chartered accountant, tax consultants are facing a big problem due to the portal not functioning on the due date, during the time of due date on 31st July, or just before the 31st July. This was due to the extraordinary pressure on the portal. So just to ease the pressure on the portal and just to give the relaxation to all category of taxpayers, it was proposed that a staggered timeline for filing of tax returns. So in case of individual taxpayers, where earlier the due date was 31st July, the due date is same, it's a 31st July. In case of businesses where there is no tax audit, in those cases, due date has been extended to 31st October. So now there will be four due dates. One will be 31st July for all individual and other taxpayers in case of business entities where there is no audits. So in case of those entities, due dates will be 31st August. In case of SSC having tax audits, due dates will be 31st October. And in case of taxpayers having applicability of transfer pricing provisions, the due date will be 30th November. So this is again a welcome amendment proposed by the finance minister. So it is going to help many taxpayers and specifically chartered accountant like us. Another amendment proposed in the Finance Bill 2026 is 100% transparent online lower or nil TDS certificate process. Even earlier, this process was online, but many times, if there was some clarification required, so the concerned officer were calling the taxpayer in their office to discuss couple of stuff. So now this entire process is made online. So how this will work? That we need to file an application for lower Indian TDS certificate. We need to attach the relevant documents along with our explanations, and the assessing officer will review all these documents. And based on the review, assessing officer will check whether these documents are proper or not, whether the application is proper or not, whether the application is complete or not, and based on which the assessing officer needs to take a decision whether they will accept the application or whether they will reject the application. So this is a welcome move. So I hope what shall be the turnaround time in this case, that needs to be seen, and how this is going to help the taxpayer, only the time will tell, but this is a welcome move by the finance minister, and it is going to help taxpayer in a broader way. Again, there is a very interesting proposed amendment. So in normal scenario, what happened that wherever there is an issue went into litigation till High Court or Supreme Court. So whenever on a particular issue, whenever taxpayer is getting any particular relief from the High Court or Supreme Court, then to nullify the effect of those High Court or Supreme Court decision, to give effect in the favor of the revenue, income tax department, finance minister were coming with some budget proposals, nullifying those High Court and Supreme Court decisions and bringing some provision in favor of revenue. This is first time where I have seen that amendment has been proposed in some of the issue where Honorable Supreme Court has decided some issue in favor of the revenue, and through the budget proposal, now the government, now the finance minister want to give some benefit to the taxpayer. So this is a classic example. So this issue is with respect to employers' contribution to PF and ESI. So normally, what is the general rule that in case of employers' contribution to PF and ESI, that amount should be deposited with the PF and ESI authorities within due date. So in case of PF, it is 15th of the next month. It is in case of ESI, it is 21st of the next month. Suppose in case of a company, there is a PF deduction by the employer in the month of January 2026. Then what is the due date for making the payment of this PF with the PF authorities? 15th Feb. So what was the provision earlier? The provision earlier was that if the company is making payment of PF within 15th Feb, then only they will allow this expenditure as a deduction while filing their tax return. So this was protested by many taxpayers across the country. Many high courts has given a decision that section 3615A should be read with section 43B, which says that certain deductions should be allowed based on actual payment basis. So certain high courts has given a principle that even if the taxpayer is making the payment of these contributions on or before the due date of filing of tax return, then they should allow as deduction. Against all these High Court decisions, department went to Supreme Court. Honorable Supreme Court, in case of Checkmate Services Private Limited, this decision was pronounced in 2022. Honorable Supreme Court has given a principle that this provision was a deterrent provision, and the intention of the legislature was that if there will be such disallowance, then only the company or employer will make the payment of these contributions on time. But there were many genuine cases also, and even taxpayers were facing some difficulty after the Supreme Court decision. So now, with this budget proposal, Honorable Finance Minister has proposed that in case of taxpayers, if they if they fail to make the payment of employer's contribution within due date is 15th or 21st, and if they are making the payment of these contribution on or before the due date of filing of return of income. So in case of company, if it is audit case, it's a 31st October. In case of non-audit case, it's 31st July or 31st August. So if the employer is making the payment of this contribution on or before the due date of filing of return of income, then it will be allowed as deduction on actual basis. So this is a very welcome amendment, proposed amendment. There is some rationalization with respect to MAT provisions. So MAT, minimum alternative tax. So in case of income tax, in case of companies also, there is a old regime, there is a new regime. And the intention of the government was that every taxpayer should move to new regime to avoid any kind of complexity. So Honorable Finance Minister has proposed certain amendments with respect to MAT provisions. So what these proposals say that in case of unabsorbed MAT credit. So earlier the provision was that you can carry forward the unabsorbed MAT credit for a period of 15 years. So now what the proposed amendments say that if you want to carry over the MAT credit, then you need to shift to a new regime of income tax. In case of old regime of income tax, you can carry over you need to utilize your MAT credit till 31st March 2026. After that, you cannot carry over the unutilized MAT credit. So in case of any companies, if they are having unutilized MAT credit, they don't have any other option but other than to shift to the new regime. Another important provision that in case of rate of MAT, so earlier the tax rate was 15%. This has been reduced to 14%. And this amendment is going to effect from 1st April 2026, that is tax year 2026-27. Another small amendment proposed by Finance Minister. So in case of sale of property by non-resident, so earlier the provision was that the seller, non-resident, was supposed to take 10 number. And based on that 10 number, in that 10 number, the buyer was depositing the TDS. So and it was a cumbersome process for an NRI to take 10 number to file returns and all these complications. To avoid this compliance burden on non-resident taxpayers, budget has proposed that in case of non-resident taxpayers, suppose if there is a sale of property, so TDS will be deposited by the buyer based on the PAN number of the NRI seller. So again, this is a very welcome move, or this will also affect from 1st April 2026. Again, so there is a welcome move in TCS. So earlier what was happening that in case of certain specified transactions, a huge amount of TCS was getting blocked in case of certain taxpayer who were using these specified transactions, and they were forced to wait for 1 year, 1.5 year, 2 year to get the tax refund from income tax department. And their money was getting blocked with the tax department. So to give the relief to the taxpayers, certain rationalization has been provided with respect to the TCS rates. So in case of overseas tour package TCS rate, which was earlier 5% or 20%, which has been reduced to flat 2%. In case of education and medical remittance through LRS, earlier it was 5%, which now it is reduced to 2%. In case of alcoholic liquor for human consumption, TCS rate has been increased from 1% to 2%. And for all other remittances, the TCS rate continues to be 20%. There is no change. And so this is a welcome move. Again, a small amendment and impactful amendment. So exemption in with respect to receipts from motor accident compensation. So in case of any taxpayers, suppose they got accident or due to their death, their legal hair are receiving some compensation from motor vehicle tribunal, or these tribunal are awarding certain compensation or interest. So this amount was earlier exempt in the hand of the recipient, in the hand of legal hair, or in the hand of taxpayer with severe disability. But earlier there was a TDS on the payment of interest to these taxpayers. So that has been removed, and now, as per the proposed amendment, interest awarded by this Motor Vehicle Act is completely exempt, and there is no TDS on any amount. An interesting amendment with respect to buyback of shares. So I can say that there was some lacuna in drafting of provisions of earlier years. So just to clear those drafting errors, or to clean those stuffs, or to make the life easier for the taxpayer. So this some amendment has been proposed with respect to buyback of shares. So let us understand the transaction. So earlier, what was the provision that suppose there is a company ABC, and this company is having one investor, and this investor has received say 1 crore rupees on account of buyback of shares. So what was the earlier provision? This amount was getting taxed as a dividend income in the hand of individual shareholders based on their applicable tax rate. So normally in case of it's a maximum marginal rate. Then you say, what about the cost of acquisition? So earlier the provision was that suppose if your cost of acquisition of those shares is 10 lakh. So this 10 lakh treatment will be separate. This 10 lakh will be treated as a capital loss. And you can carry over and set off against any other capital gains, short term or long term, subject to their holding period. So this arrangement was treated as tax planning tool by certain companies, and subsequently the department realized their mistake, that there was something there was some there was some issue in the drafting of these provisions, and the taxpayer are getting undue benefit from this particular provision. So through this proposed amendment. Now they have simplified the thing. How you will calculate the capital gain? Straight away, simple. Sale consideration, less cost of acquisition. So in this case, in my example, sale consideration is 1 crore, cost of acquisition is 10 lakh, 90 lakh rupees capital gains. How you are going to tax? So in case of individual shareholder, it will be taxed at the rate 30% flat. So this is a special tax rate. And in case of if the shareholder is a company, then the tax rate will be 22%. So what you were getting the benefit of capital loss, that capital loss was getting adjusted against your capital gain. So now there is, so even if in the new regime, so from after the amendment, you need to pay full tax on this buyback, even if you have brought forward losses. So there is no clarity on the by reading the finance bill and the memorandum explaining finance bills, there is no such clarity that if I have unabsorbed capital gains, whether that capital gains can be set off against this income. So there is this point is still not there. So I'm presuming that okay, I think they will add it in the for final draft. So this is a buyback of shares. Again, this is a welcome move by finance minister. So they are giving exemption for income from data center services. So nowadays, this is era of AI, and government want to push. Government want to make sure that many companies should use this benefit. So this benefit is specifically allowed to a foreign company. What this says that if a foreign company, so let us understand this provision with an example. Suppose there is an Indian company who has set up a data center in India, and this foreign company is providing services. This Indian company is having a data center in India, and this Indian company is providing some services to a foreign company. This foreign company will use these services to provide their services in India. And from providing those services, if they are receiving any income, then that income in the hand of foreign company will be tax free. So how this particular provision is going to work? So a detailed rules and process not yet notified. So we are expecting more clarity on this particular provision, that how the income of that foreign company will calculate in India, and how the suppose if an Indian company is providing multiple services, then how the income from the data center services will be segregated, or practically what will be the practical implications of these stuff. Because if you are providing this benefit to the income of the foreign company, then Indian company will also come that case. So if you are giving the benefit to foreign company, then why not the Indian company? Why the foreign company should have an edge? So we are also expecting some kind of clarification on this particular stuff, that how it is going to do practically. So we'll wait for the detailed rules and notifications. So now I'm coming to amendments with respect to assessment and appeal proceedings. An interesting amendment proposed by finance minister, and this is my favorite topic. So you need to first understand what is happening now, and what is proposed as per the new finance bill. So currently there is scrutiny proceeding going on in case of suppose company ABC. Assessing officer has passed an order and raised a tax demand of say 5 crore. Done, complete. Against that addition on the assessment order, ABC Company Limited has filed an appeal before CIT appeal. Simultaneously, the assessing officer has issued a so-cause notice that since there is addition in the assessment order, so why penalty should not be imposed in your case. As per the guidelines, as per the section 275 of the Old Income Tax Act 1961, if a taxpayer has filed an appeal before CIT appeal, then the penalty proceeding should be kept on hold till the disposal of appeal by CIT appeal. And even if CIT appeal has passed the order against the SSC can file an appeal in ITAT. And SSC can also file an application before the assessing officer to keep the penalty proceeding in abeyance till the disposal of appeal by ITAT. So this is the current provision. Now, what is proposed? So in this case, if there will be penalty, suppose if assessing officer, after suppose if there is a negative order, so the penalty amount would have been 100% of tax amount, which is 5 crore. So now I'm coming to the proposed amendment. What is happening with the proposed amendment? So as per the budget speech and as per the plain reading of the memorandum explaining finance bill, it is explained that they are giving some relief to the taxpayers to avoid any kind of litigation. So I have deep down this particular stuff, and I personally feel that there is matlab, so it is against the SAC. So let me explain you how. So in the same scenario, suppose after this amendment becomes act, an assessing officer is passed on same order, imposing, making an addition and raising a tax demand of 5 crore. So as per the plain reading of this proposed amendment, what will happen now? Instead of issuing so-called notice, the income tax officer will impose penalty simultaneously on the addition amount. So suppose in this case, if there is tax demand of 5 crore, income tax officer will also impose a penalty of 5 crore. Now you pay. Now there is tax demand of 10 crore in your head. So earlier it was 5 crore only. Now it's a 10 crore. So again, this is detriment for not good for the, as per my view, it is not good for the taxpayer. It will avoid a separate penalty proceeding. I'm agree. But suppose if there is a assessment order in the, suppose if there is an addition in the assessment order, which as per the taxpayer feels, if the taxpayer feels that this assessment order is not good and the addition is not good, then the addition will pinch the taxpayer and simultaneously the penalty will also pinch the taxpayer. So yes, so there is avoidance of multiple litigation in this case, but quantum of demand in the head of taxpayer will be much, much higher. So I don't know how this will take effect in the final act, but I guess ideally there should be some provision that this penalty, which is determined in the assessment order, should not be demanded from the taxpayer till the time appeal is disposed. This is as per my view, this should be an ideal scenario. That penalty amount should not be demanded from the taxpayer. Another important stuff which Honorable Finance Minister during her budget speech had stated that in case of in case of tax demands in the assessment, stay shall be granted if we pay 10% of the disputed tax amount. However, this was not captured in memorandum explaining finance bill or in the copy of finance bill. So I guess they will incorporate it through certain notification or circular. So this is a welcome move, but and this amendment will apply from for orders passed on or after 1st March 2026. Jurisdiction to issue notice under section 148. So in this case also, so again there was lots of litigation with respect to issuing of notice under section 148. Jurisdiction issue of notice under section 148. In last in during 2019-20, all the assessment went faceless. But the issue with respect to who will issue reopening notices, whether jurisdictional officer will issue the reopening notice or whether a faceless unit of the faceless assessment unit will issue the reopening notices. In many cases, these notices were issued by jurisdictional assessing officer or faceless assessing officer, and it was found that these officers has exceeded their jurisdiction, or these officers has issued the notice without having proper jurisdiction, and these notices were challenged by the taxpayer through writ in various high courts, and various high courts has decided in favor of the taxpayer or in some cases in against the taxpayer. Then the matter went to Supreme Court. Honorable Supreme Court has clarified the stand in case of Ashish Agrawal, Union of India versus Ashish Agrawal, where Honorable Supreme Court has given the principle that all the old notices issued on or before a prescribed date shall be invalid, but the notices issued as per under section 148A will be valid subject to certain conditions. To avoid these kind of anomaly with respect to jurisdiction of reopening notices, a amendment has been proposed. What this proposed amendment says? This proposed amendment says in case of all the reopening proceedings, in case of all the reopening reassessment proceedings, the notices shall be issued by the jurisdictional assessing officer only. All the work with respect to pre-assessment, inquiry, and issuing of notices, this is the prime responsibility of the jurisdictional assessing officer only. And it is a duty of the jurisdictional assessing officer, not the faceless unit of assessment. Jurisdictional assessing officer only will issue the notice, and based on this notice, the assessment will be taken over by the faceless unit of assessment, income tax. Assessment unit of faceless assessment unit. Interesting part, now this amendment has brought retrospectively with effect from 1st April 2021. I'm just wondering that what will happen. Suppose and how department is going to treat this. Suppose there was an old notices issued by department under section 148 or 148A, which was challenged by the taxpayer, and Honorable High Court has struck the notice. Now, with effect from 1st April 2021, since this amendment was brought retrospectively from 1st April 2021, Department is going to reopen all the cases where the notices were stuck down by the various courts due to judicial issues. So at one point, finance bill is proposing to reduce the litigation, and at the another point, finance bill is trying to reopen the old dead litigations. So this is again detrimental. So if all these cases will get reopened, then I think this will be detrimental for all the taxpayers, in which case these notices get quashed. And I personally believe that again, this will result into a further litigation before High Courts and Supreme Court. So this will not end litigation in this case. A new disclosure scheme has proposed to be brought with respect to disclosure of foreign assets. So to help the small taxpayers. So who are the small taxpayers? So as per the memorandum explaining finance bill, so small taxpayers includes salaried person who has received ESOP, employee stock option, and RSU units of their foreign entities, foreign parent companies. Students who went abroad for studies and then they returned to India. And when they were in foreign countries, they have opened some bank account and they kept some nominal amount in their bank account, or some expatriate, some employees who went out of India for temporary work in their company and they have opened some bank account. So normally these small taxpayers are not well aware about this technical integrity with respect to disclosure of foreign asset, and they are of the thought that since there is no such income from those assets, so hence they did not disclose this. And since India has signed certain treaties with various countries, so now they are getting information from various sources about Indian taxpayers are having foreign assets in which locality. So they are getting quite classified information in all these cases. And since these foreign assets has not disclosed in their tax returns, so it will it may result into a application of draconian provisions, a huge penalty as well as prosecution. So to avoid all the small taxpayer all these hassle, finance bill proposed to bring this disclosure, one-time disclosure of foreign assets for all these people. So the rules, not rules, regulations, process will be notified later. So then only we will see the how it's going to work. So this disclosure scheme will be effective from 1st October 2026, and this will cover all past non-disclosure of foreign assets by small taxpayers. Again, there is some relaxation with respect to taxation of unexplained income. So as per earlier Income Tax Act at 1961, if certain persons were having some unexplained cash, investment, assets, expenses, or some transactions covered under Section 68 or 69 A, B, C, D, so they were earlier taxed at a higher rate of 60% plus an additional penalty of 10%. So now, through this proposed amendment, this tax rate is proposed to be reduced from 60% to 30%, and this separate penalty is proposed to be removed. So there are certain amendments proposed with respect to transfer pricing, international taxation. So one is the rationalization of safe harbor rules. So in case of various different IT services, earlier there was no clarity that which service will fall under which category. So with respect to ITs and KPO and other contract R&D services, so consolidated into one single IT services with a uniform safe harbor a rate of 15.5%. Earlier, this range was from 17.20 to 40%. So this is a welcome amendment proposed. Again, so some timelines has been relaxed in case of safe harbor rules. Another proposed amendment is with respect to advanced pricing agreement. So now, in case of unilateral APH for these IT services, so earlier timeline has been completion of these process should be up to 2 years, and which may extend up to 6 months. Another welcome proposed amendment is with respect to transfer pricing order. So earlier, what was happening that in case of the transfer pricing officers was passing the order very late, and once the transfer pricing order was communicated to the taxpayer was getting very limited time to respond to the judicial assessing officer, due to which there were lots of litigation before the court that these orders have been passed by violating the principle of natural justice. So now an amendment has been proposed that a clear 60 days time should be given to the taxpayer from the date of passing of transfer pricing order to respond to those queries to the judicial ITO. Apart from that, there are many miscellaneous, there are many other amendments. One of the major amendment is with respect to prosecution proceedings. So many of the offenses as per Income Tax Act has been decriminalized. In case of many of the offenses earlier where the prosecution timelines was from 1 month to 7 years, the timelines had been substantially reduced in many of the cases. The list is too long. So if you want to get this list, then you need to refer to the memorandum explaining finance bills. Or since the time is very less, I'm not reading out all these stuff. So this is a welcome move. Another interesting amendment is with respect to mistake in quoting of DIN. So as per the earlier provisions, like if an income tax officer is issuing any document, so as per law, they should quote DIN number in that particular document. Without DIN number, the document was not having any validity. So in case of many cases where order has been passed by the assessing officer and the DIN was not properly mentioned, so courts across the country had taken the view that in case of absence of DIN, the assessment should be nullified. The assessment order is having no effect. So there was some Delhi High Court decision in case of Brandex Mauritius, so which says that assessment order passed without DIN is void ab initio. So now Finance Bill 2026 through this amendment proposed retrospectively that in case of any document is not bearing DIN, then it is a technical error in the document, and that technical error does not make the entire assessment void. And this technical error can be rectified by doing certain steps, but assessment cannot be quashed. So again, this is a retrospective amendment. So so apart from that, many of the relaxation has been given to many of the penalty provisions and some of the tedious provisions. So with this, I'm concluding my presentation. So now I will take queries of all the viewers. So I will take the queries one by one from YouTube if any queries are there from the viewers. So let me check. I think there is no queries from the viewers on YouTube. So with this, I'm concluding.